Ladies and gentlemen, we interrupt all regular programming with a critical financial bulletin of immediate importance. At this very moment, markets across Iraq and Vietnam are witnessing unprecedented movement as the newly established Tier 5 foreign exchange platform has just commenced operations. The repercussions are already being felt in the dramatic surges of the Iraqi Dinar and the Vietnamese Dong, which are beginning to ripple through financial systems, businesses, and individuals alike. Our coverage tonight goes straight to the heart of this development, providing you with a detailed, real-time breakdown of what has just occurred, what it means for the markets, and what could follow in the hours and days ahead. The headlines cannot overstate the significance. A Tier 5 exchange has come online, and with it, the Iraqi Dinar and Vietnamese Dong have triggered an extraordinary ascent in value. Currency traders, financial institutions, importers, exporters, and individuals holding either of these currencies are now encountering wild swings in valuation, generating both opportunity and uncertainty. What we are witnessing may mark a historic inflection point in the regional and global forex landscape. Let us begin at the outset. Just minutes ago, regulatory authorities in Baghdad and Hanoi formally approved the launch of the Tier 5 platform. This new exchange integrates cutting-edge digital trading infrastructure with enhanced liquidity pools supported by international banking partners. Within moments of its activation, bid-ask spreads for both IQD and VND tightened dramatically, while transaction volumes soared. The platform's algorithmic engines executed orders at a pace hitherto unseen for these currencies, driving the immediate upward pressure on their spot rates. In exceeded hundreds of orders, demand for Iraqi dinars flooded the system. Buyers, from regional importers to financial institutions, were aggressively seeking coverage, prompting market makers to escalate their selling prices. As the exchange tanks accepted orders, the dinar's value began to climb, inching upward at first, then accelerating. Across trading desks, analysts watched in disbelief as the rate began to spike with velocity. The Vietnamese Dong mirrored this pattern, with demand surging from exporters, investors, and remittance services. Liquidity providers, sensing the opportunity, raised their price levels, creating a feedback loop that fueled further appreciation in value. Across both currencies, ask rates are climbing, and the market is responding in real time. It is essential to convey just how rapid this shift has been. A matter of minutes elapsed between platform activation and the first visible adjustments in official rates. Within an hour, reports are suggesting double-digit percentage increases in valuation for both currencies against major benchmarks. Market desks now scramble to confirm precise numbers as volatility has surged to levels only seen in rare, fleeting episodes. The speed and intensity of this movement is drawing the attention of central bank watchers, currency strategists, and global traders alike. But let us focus on the human and operational impact, starting with the institutions that rely on these currencies every day. Commercial banks in Baghdad are now recalibrating their front-door exchange rates for their clients. Importers who purchased goods in dinar are suddenly facing more favorable conversion conditions, but must act quickly to lock in rates currently on offer. Exporters, who typically convert dinar to dollars or euros, are watching rates climb with cautious optimism that they may benefit from more favorable receipts. On the flip side, remittance corridors sending VND abroad are scrambling, trying to optimize send-and-receive flows amid shifting numbers. These rush dynamics are accompanied by heightened anxieties. Treasury departments are racing to update hedging strategies. Corporates that were previously short the dinar or the dong are now seriously exposed. Any delay in rebalancing positions could prove costly. Brokers and liquidity providers are erecting circuit breaker measures to prevent disorderly trades or erroneous executions amid such torrid session. Risk management teams are tightening limits, monitoring each tick with acute attention. Market watchers who have long scrutinized both the IQD and VND markets are utterly captivated. The Tier 5 exchange's design, combining institutional-grade infrastructure with cross-border settlement flexibility, seems to have shattered a decades-old barrier limiting price discovery. What was once a largely illiquid, opaque, tightly controlled currency environment is now being transformed, in real time, into a more transparent, dynamic arena. The implications are profound. Improved price discovery can invite deeper participation, but it also exposes both currencies to speculative flows and macroeconomic ripple effects. Meanwhile, central banks are drawing heightened scrutiny. The Central Bank of Iraq and the State Bank of Vietnam find themselves thrust into the spotlight. Are they prepared or willing to intervene in markets now moving at this pace? Observers are watching for prompt signals. Any commentary or policy statement from either institution could drastically influence market trajectories. If they intervene, rates may moderate. If they choose to let the market absorb these shifts, valuations may continue to surge. For now, their silence, or any coded statement, will carry disproportionate weight. In trading rooms throughout Baghdad, Hanoi, London, and Singapore, every desk is active. Traders who previewed the platform's launch knew opportunity lay ahead, but few anticipated such immediate and extreme moves. The dinar, often labeled a static currency, is now exhibiting unprecedented dynamism. Likewise, the dong, while more actively traded, is now showing bursts of volatility rarely seen. Speculative interest is likely to expand as short sellers reevaluate their strategies and long-only holders may choose to add exposure. Now, let us consider the macroeconomic ramifications. If sustained, these sharp upticks in currency value could immediately impact trade balances. A stronger dinar and dong will make exports from Iraq and Vietnam more expensive on the global market, potentially dampening demand. Imports become relatively cheaper, which may ease domestic price pressures, especially for fuel, machinery, raw materials. In Iraq, where import reliance is significant, consumers could benefit from lower price tags. In Vietnam, which has a robust export sector, exporters may face compression in margin unless engaging in active hedging. But these aren't just local ripples, they could generate global effects. International corporations with exposure to these markets may revise earnings guidance. Commodity markets, particularly oil, may respond if Iraqi import dynamics change. Regional FX trading desks may adjust carry trade strategies. Multilateral lenders and regional economic analysts will review forecasts to account for disruptions. Turning back to domestic impacts, we must emphasize the urgency retailers, small businesses, and individuals now face. A small shop owner in Baghdad holding dinar cash may suddenly realize that the value of their holdings has spiked. Is now a moment to convert or wait for further gains. A garment factory in Hanoi awaiting export proceeds may find that timing conversion now could mean better funds inflow, or could they move even higher? Households sending remittances abroad face shifting exchange receipts. Every stakeholder is watching live data, weighing decisions amid sheer uncertainty and risk. The new Tier 5 platform's architecture is also grabbing attention. It is reported to feature real-time settlement windows, direct bank-to-bank connectivity, and a highly adaptive pricing algorithm. This infrastructure removes many of the traditional frictions, like long settlement lags and opaque pricing, that characterized past FX systems in both countries. The effect is dramatic. Markets that moved incrementally over days now move in near real time. The interim data that traders relied on is now replaced with continuous streaming updates. And so, markets are disconfirming patterns that were once normative. Regulators in both jurisdictions may soon weigh in to ensure orderly functioning. Imposing temporary transaction caps, limiting intraday price swings, or adjusting liquidity tier access may come under consideration. Both countries have past precedent of measuring and managing FX volatility, but perhaps not at this pace or magnitude. International financial institutions may step in with advisories or support. Lenders like the IMF or World Bank may offer stability mechanisms if needed.